Hello and welcome back. My name is Josh, and today I want to go over the recent pullback that we've seen in the market. So, depending on the market, SPY, which is the S&P 500, has been down about 10%. NASDAQ or QQQ has been down about 15. There was a bit of a bump on Friday, so my numbers might be a little out of date. But there was definitely some turbulence in the market, and a lot of people, especially first time or newer investors, saw red for the first time in a while. I mean, maybe if they're in growth stocks, they've been seeing red for a bit now, but today, the last couple of weeks, has been especially tough. And so I want to take this time to remind you to ask yourself, are you a long-term investor? That's really the only thing, because if you are, you shouldn't worry about it. I made a video a while ago. You can check it out here. That was about how I said, the market should see a pullback and maybe even lower expected returns in the next couple of years. So this was not to be out of the ordinary. In fact, about every 10 years, we see a major correction in the market, and we see minor corrections even more frequently than that. I think we see pullbacks every 12 to 18 months. And again, the entire market hasn't been hit. When you look at what I call hyper growth companies, those could represent those held by ARK. ARK's down about 50%. So those companies have seen a huge correction. And NASDAQ, which is tech heavy, has seen 15, 16% correction. Meanwhile, like the general market's only seen about a 9% correction. So it's hit everyone, but it's hit tech especially poorly. And if it's hitting tech especially poorly, it means there's other companies that have actually done okay or better than the market. So financials have done fine, energy's done pretty well. Excuse me. So again, I want to remind you, are you a long-term investor? Because if you are, you should actually be looking to buy. Hopefully you have some cash on the sidelines, but that's what I've been doing this week is, again, this is opinions, not advice, but I've been buying. I've been trying to put money into great businesses at decent valuations that have a good amount of cash flow. So to me, why is the market down? Well, it's all to do with the Fed. There's nothing to do with these businesses from a fundamental standpoint that's wrong. Peloton aside, which I discussed that, they've had some demand issues, but a lot of these tech companies have no demand issues. They're still growing. They're still doing well in all those senses. But what's happened is the Fed has said, hey, we're going to raise rates. We're going to cut back on QE. In fact, we're going to start, instead of buying up assets, we're going to be selling bonds. Technically, all you need to know is that's taking away liquidity from the market. So instead of adding liquidity to the market, printing more dollars, they're taking more money out of the system and they're raising interest rates. And raising interest rates does two things. One, it makes borrowing more expensive. So if you're a cash flow negative business, a fast growing early stage company, you need to borrow money or sell equity in order to keep operations going. So it's now more expensive to keep operating because you need to borrow money at higher rates. That's one. And two is when you're valuing a company, you're basically trying to value what is the cash flows of that business in the future. All businesses should be valued based on their cash flows at some point in the future. Could be money losing today, but one day it's got to make money. And the further out that money is, the more you have to discount it. So a dollar today is worth more than a dollar tomorrow, which is worth more than a dollar in 10 years. Now, when interest rates are low, the dollar in 10 years might be worth only 90% of today, just as an example. And when interest rates are really high, it might be worth $6 because you have to discount it at a higher rate because I could be earning interest today. So that's your opportunity cost. So when interest rates go up, it hurts what we call long dated assets. So those are assets that make money longer into the future. So again, these are typically young growth companies because a company like Walmart's making money today. They're making cash flows today. Well, a young tech company is making no money today. In fact, they're losing money today, and they hope to make a lot of money in 10 years. Just take a look at Amazon, for example. They lost money for years and years, made almost no profit, but kept growing, and you can see their valuation was down 90% at one point, then flat. Obviously, it's done very well now because it eventually made tons of money, and today it's a cash flow machine. But interest rates will have an impact more so on these long-dated assets, so these young tech companies. So what am I doing? I really think you should, again, it's like a store. If something's 50% off, if you liked it at 40, you should love it at 20. And so I'm really saying, what companies did you really, really like that you want to, and I would invest more into those. That's what I look. Now, the only caveat is unless two things have happened. One, has the business fundamentally changed? And some people might say again, I like using Peloton, it's my favorite example. Peloton, you could say the business has fundamentally changed. There is no demand. That is a business problem. So I want to stay away from that. That's completely okay. I have actually not bought any more Peloton. Given this, I think it's actually a very attractive price, but I'm already over invested, so I can't put any more into it. And the second reason is if you are a money losing company, um, and you are worried about the risk of solvency, i.e., will it go bankrupt? So again, there's some companies that have tons of money on the cash on their balance sheet. They have billions of dollars in cash. Those companies are probably going to be fine and they're going to be able to withstand this. But if you have not a lot of money in cash and high debt and you constantly need to refinance your debt, if you have to refinance debt at a higher interest rate, that means that more of your money is going to go towards paying off your debt, which is going to make it harder to turn a profit. So some companies that are smaller and have higher debt loads will have a little bit more trouble in this interest rate environment. So those are the two types of companies that I think maybe you could say, if I didn't like it at 40, I'm going to love it at 20, unless you're afraid of that they're not going to be able to pay back their debt because of higher interest, or if you just think there's something that's fundamentally changed with the business. If the economy were to shrink, people would start spending money differently. I still think people would spend money on Netflix no matter what. I think that's become a necessity. So Netflix is down 50% because they had weaker guidance for next year. I think they had, people were expecting 5 million subs next quarter add, and instead they said, well, we're likely only going to add 2 million subs. I think that if there was, I won't say a recession, but a major pullback and a contraction in the economy, people will just still need Netflix. That's what they watch. That's become the de facto TV instead of cable. So I think that's still going to stick around. But will they maybe buy less Pelotons? I think there's an argument to be made that if there's a contraction and people lost their jobs and people have less disposable income, that they might spend less on Peloton. So again, there is an argument to be made there as well. So there's a risk adjustment. Not saying there will be a contraction, but there is more of a risk because of what the Fed is doing. So, but I'm looking for companies that have great businesses, have tons of cash, and I liked before. So to me, the most obvious example is Google. Google makes billions of dollars in free cash flow, billions. And they're down about 9% from a week ago, maybe 10% from their all-time highs. And I picked up some last week when it was down about 12% actually. And because to me, hey, you're making billions of dollars, and so there's no issue with the Fed raising rates that they're going to need to borrow money. There's no issue of solvency, none of that. And it's still just as good a business as last week. What the Fed does, if it's a good business that doesn't have an issue with solvency, what the federal government does should have no impact on the business. It might have people might value it differently, but at the end of the day, it's still a great business and it's still going to make the same amount of money. So if I liked it at 3,000, I wasn't buying at 3,000, but if you did, you should love it at 2,600. And that's really what I'm trying to do. I'm trying to find companies that I love, that I think have good cash flow yield. So again, Google has about a 3.5, maybe it's just under that, let's say just under a 3.5% cash flow yield. That's how much cash flow they make versus how much you're buying it at. At 25p, these are reasonable numbers. So this company is not overvalued like some other companies might be. And the other thing I'm doing is I'm looking at my watch list. I have a watch list of all the companies I really, really love, but I think are overvalued. So just as an example, one Snowflake. I think Snowflake's an amazing company. I think it's growing like crazy. But to me, it is very, very, the valuation is hard for me to stomach. So again, you still want to look at valuation. But now that it's dropped, well, I say, okay, is the valuation now a little more reasonable? And you have to look at where you want to enter. So to me, if you already bought companies and you already like the valuation, do the work again, make sure does the valuation still work? And for me, there's a lot of these big companies that do. Apple, Alphabet, some of these big ones I still think make a lot of sense. Berkshire Hathaway I bought because I think they also have a ton of cash. I'm looking for companies with tons of cash because again, I also think there's going to be a big amount of acquisitions because some of these companies are now on sale. And so they're going to go hunting for some acquisitions. So those are my criteria, but this opinions, not advice. Look for companies that you really believe in, you still think are going to be able to do well in any environment. So they're resilient. They don't just need to, Robinhood to me is not one of those companies. Robinhood needs stocks basically constantly going up because when everything's going up, people are trading more, which helps Robinhood's business because they make money when people trade. When stocks are going down, it tampers excitement around the stock market, and I think that's really going to hurt their revenue. So even if you like the company at 20 and now it's 10, I would stay away from Robinhood personally, and this is just my recommendation because I think people are just not as excited about it, and there's so much volatility in their revenue. I mean, they made at one point, like one quarter, I think they made 30% of their revenues or their earnings just from Dogecoin, and 100% of that basically disappeared. It went from 30% to like 2% because Dogecoin activity went down. So this is not revenue you can predictably rely upon. Again, just because you can't rely upon it and predict it doesn't mean that it's not there, but it means it's harder to model out. This is why companies like Warren Buffett, he doesn't like tech companies and these growth companies because it's harder to model their growth. He likes a company like Coca-Cola where you can predictably say people are going to buy Coke tomorrow and the day after that, and you can reasonably say what the growth rate is going to be. In fact, if you want a predictable company, look at Microsoft. They have been growing steadily for the last 20 years, almost no change. Every quarter, they just keep growing revenue. They're a machine. They recently bought Activision. I think it's a great company. It's well diversified. They have very little antitrust risk. Again, I love Google, but there is a little bit more risk there that if they tried to make an acquisition, the FTC would shoot it down because they think that there's some monopoly powers being abused. But anyway, look for these companies that are great companies, cash flow machines, keep growing, and will do well in every environment. And I think there's a lot of them out there. And just know that it's time in the market, not timing the market. Might go down another 15%, might go down another 20%. No one knows. But if you're a long-term investor, I only need this money for 30 years. If you're a trader, this could be bad. Maybe you want to ride the momentum, but I don't care about this money for 30 years. So I want to know, is this money going to do better in 30 years than it is today? That's all I care about. And to me, if I liked Alphabet last week, I love it today. So I'm just going to keep buying these companies and say, hey, I'm going to hold this company for 30 years. So I don't care whether I buy it. Obviously, I'd prefer to time it perfectly, but no one can do that. So I'm just going to keep buying it on the way down. I'm going to slowly keep buying on the dip. And guess what? There might be pain ahead. But if you're not willing to stomach the volatility down, then don't expect to enjoy it on the way up. Like you have to do it on there's volatility both ways. So just know that this is part of the market, is taking your lumps and seeing the market go down. It's no one likes it. It's not fun, but it's part of the market. And if you want to be a long-term investor, this is part of it, and you should be looking for opportunities during these times. So look at it as a good thing. You got to change your mindset because you're looking for bargains now. If you loved it last week, you're going to love it today. So anyway, those are my thoughts. Let me know. Are you buying anything? Are you running scared for the market again? I would suggest not selling unless you really think the market is crashing or something, but I'm not selling. But let me know what you think in the comment section below. Thanks very much for watching and talk to you next time. Cheers.